For 24 years, Elon Musk did something almost no founder in modern history has done. He built one of the most valuable companies on the planet and refused, again and again, to let ordinary people buy a single share of it. No ticker symbol, no quarterly earnings calls, no appearing on your brokerage app next to Apple and Tesla. If you wanted in, you couldn't just log into Robinhood and buy SPCX, because until a few weeks ago, SPCX didn't exist. This is the story of why SpaceX resisted the public markets for longer than most tech companies even survive, and the very specific, very strange mechanics of how a company gets to be worth over $1 trillion while staying almost completely invisible to Wall Street. Part 1. How do you get rich from a company you can't buy? Here's the question that should bother you. If SpaceX wasn't on the stock market, how did its valuation keep showing up in headlines? $210 billion in 2024, $350 billion months later, $800 billion by the end of 2025. Where do these numbers even come from if there's no public trading? The answer is a mechanism most people have never heard of: the tender offer. Twice a year, SpaceX opens a narrow, company-controlled window. Employees and early investors are allowed to sell a limited slice of their shares, not to the open market, but to a pre-approved set of buyers at a price SpaceX itself sets. The company decides who can sell, how much, and at what valuation. Then it closes the window again. That's the entire pricing mechanism for one of the most valuable companies on Earth. Not millions of buyers and sellers setting a price every second like on the NASDAQ. A handful of private negotiations, twice a year, dictated almost entirely by the company. Think about what that actually means. When a headline says SpaceX is worth $800 billion, that number wasn't discovered by a market. It was decided. Part 2. The math nobody likes to say out loud. Here's where it gets uncomfortable. By early 2026, analysts were estimating SpaceX's revenue at somewhere around $22 to $24 billion a year. At an $800 billion valuation, that's roughly 33 times sales. At the $1.5 trillion number Musk was reportedly chasing, that's over 60 times sales. For context, a normal rocket and satellite company, hardware, manufacturing, physical things that occasionally explode on a launch pad, does not usually trade at 60 times revenue. Software companies sometimes do, because software scales for almost nothing. Hardware doesn't work that way. You can't 10x your output by flipping a switch in the cloud. You need factories, fuel, steel, and humans who can survive a rocket blowing up on the pad without quitting. So why did the number keep climbing anyway? Because the valuation wasn't really pricing SpaceX, the rocket company. It was pricing Starlink, the satellite internet business that had grown past 10 million subscribers, and a bet on Starship, the ambitious next-generation rocket that hadn't yet proven it could reliably do what Falcon 9 already does. A huge chunk of that $1 trillion number was a wager on the future, wrapped around a present-day business that, while genuinely profitable, wasn't anywhere near big enough to justify the sticker price on fundamentals alone. And here's the part that should make any employee holding stock options pause. Every one of those tender valuations was set by the company that benefits from the valuation going up. SpaceX picks the price. SpaceX picks who can sell. There's no short seller allowed to bet against it, no hedge fund publishing a report calling the number inflated, no mechanism for the market to push back if it disagrees. Part 3. The hype versus the reality. Here's the contrast that actually matters. In the public imagination, SpaceX going public was supposed to be a pure-play space stock, a way for ordinary investors to bet on rockets, Mars, and the future of human spaceflight. That's not what happened. In February 2026, Musk merged SpaceX with his AI company, xAI, in what was reported as the largest corporate combination in history, a combined entity valued around $1.25 trillion. By June, the company that actually went public wasn't a rocket company at all. It was a conglomerate. Rocket launches, satellite internet, an AI chatbot, and the X social platform, all bundled into a single ticker. One financial commentator put it bluntly months before the listing: investors think they're buying a space stock. What they're actually getting is an internet service provider with a rocket division attached, now stapled to an AI company. That's not a small detail. That's the entire thesis changing underneath people who'd been excited about this IPO for years. The thing that finally went public on June 12, 2026, raising $75 billion at a valuation north of $1.7 trillion, was not the company most retail investors had spent years dreaming about owning. Part 4. Why resist the markets for so long in the first place? and why finally cave?
Going public means disclosure, quarterly earnings, SEC filings that competitors, journalists, and short sellers can pick apart line by line. It means activist investors who can buy a stake and demand a board seat. It means a stock price that moves every time a rocket explodes on a live stream, whether or not the explosion is actually bad news for the business. Staying private let Musk avoid all of that for over 2 decades, while still finding a way to reward early employees and investors. The twice-a-year tender system functioned almost like a private, slow-motion stock market, just one with no outside scrutiny and no public accountability. So why finally do it? The honest answer is the same reason most resistant founders eventually cave. The company got too big to fund itself quietly. Starship, AI data centers, lunar infrastructure. SpaceX's own internal memo described needing capital for an insane flight rate and Ambitions that private tender offers, however large, couldn't fully bankroll anymore. At some point, even the most reluctant founder needs public market money to keep the most expensive bets alive. Where this leaves you? SpaceX is now a publicly traded company. You can technically buy a piece of it, but the company you can buy isn't the one most people spent years wanting to own. And the price you're buying in at was shaped for 2 decades by a closed-door pricing system designed to only ever go up, with no market mechanism ever allowed to test whether that price was actually true. So here's the question worth sitting with. When a number gets repeated often enough by headlines, by employees, by the company itself, at what point does everyone simply agree to believe it, whether or not the math underneath it ever really held up?